Okay, so let us go ahead and take on one more example on IND AS 103 and 110. Yes.
Yes, sir. On 1st Jan 20X2, Viagem acquired 90% of the equity share capital of Greca in a share exchange in which Viagem issued 2 new shares for every 3 shares it acquired in Greca.
How many shares? 2 shares.
Yeah.
So
Two
I'm
new
offering
shares
2 shares
for
in
every
my
three.
company for every 3 shares acquired. Then
Additionally, on 31st December 20X2, Viagem will pay the shareholders of Greca $1.76 per share acquired.
I also promise to pay $1.76 for every share I purchase from your shareholders, right? From you people. I'm going to pay $1.76 for every share acquired, not today, after 1 year. Now, I bought your company on 1st January 20X2. I'm going to pay something called the deferred consideration of $1.76 in cash after 12 months. Next.
Viagem's cost of capital is 10% per annum. The deferred consideration has not yet been recorded by Viagem.
Okay.
At the date of acquisition, shares in Viagem and Greca had a stock market value of $6.5 and $2.5 each respectively.
Okay, so my shares are trading at $6.5. Your company shares are trading at $2.5. Next.
Now, statement of profit or loss for the year ended 30th September 20X2. Now, the revenue for Viagem and dollars in thousands, and then for Greca dollars in thousands.
Okay, so from the data given, it's October to September, okay, the accounting period. Yes.
Revenue 64,600 and 38,000.
It is all dollars in thousands. Next.
Cost of sales 51,200 and 26,000.
Okay.
Gross profit 13,400 and 12,000.
Next.
Now distribution cost 1,600 and 1,800.
Okay.
Administrative expenses 3,800 and 2,400.
Okay.
Investment income 500 and nil.
Okay.
Finance cost 420 and nil.
420 and nil. Okay.
Profit before tax 8,080 and 7,800.
And 7,800. Okay.
Income tax expense 2,800 and 1,600.
Okay.
Profit for the year 5,280 and 6,200.
Okay.
Equity as at 1st October 20X1. Equity share of $1 each, 30,000 and 10,000.
It is just focus on the 10,000. That is for Greca, right?
Yeah.
It is 10,000. It is a $1 share, and these are dollars and thousands, right? So if we divide 10,000 by $1, there will be 10,000 shares in Greca in thousands. Fine. Next.
Retained earnings 54,000 and 35,000.
It is $35,000 balance and retained earnings on 1st October
X1.
X1.
The following information is relevant. Number 1, at the date of acquisition, the fair values of Greca's assets were equal to their carrying amounts with the exception of 2 items. Number 1, an item of plant had a fair value of $1.8 million above its carrying amount.
That means here there is a fair value uplift. You know, here there is an increase in the value of the asset, right? How much? $1.8
million.
$8 million. Or I can say it is $18 lakh, or you can say 1,800 in thousands. Next.
The remaining life of the plant at the date of acquisition was 3 years.
3 years left in the asset. Next.
Depreciation is charged to cost of sales.
Okay, that means what? At least earlier some we had to assume, right, in the previous video. But here what happened, they given the depreciation is a part of cost of sales. Next.
The second item, Greca had a contingent liability which Viagem is estimated to have a fair value of $450,000.
So please remember, this $450,000 will not be a part of Greca's balance sheet being a contingent liability. But you all know from IND AS 103, as long as the fair value of the contingent liability can be measured reliably, it will be a part of a net assets acquired computation. Is that fine? Yes, for $450,000.
This has not changed as at 30th September 20x2.
If there is a change for the increase, you can debit your profit and loss account. But here, no change by the year end. Next.
Greca has not incorporated these fair value changes into its financial statement.
That's it.
Second point, Viagem's policy is to value the non-controlling interest at fair value at the date of acquisition.
Very clearly given that the non-controlling interest will be taken at fair value, right? And not at proportionate net assets. Next.
For this purpose, Greca's share price at that date can be deemed to be representative of the fair value of shares held by the non-controlling interest.
So remember the $2.50, right? Being the share price of Greca, that will be taken to measure the fair value of non-controlling interest. Next.
Number 3, sales from Viagem to Greca throughout the year ended 30th September 20x2 had consistently been $800,000 per month.
It is $800,000 per
month.
Is a sales made by whom?
Viagem to
by
Greca.
Viagem
To Greca.
To Greca, right? So Viagem to Greca, it is $800,000 per month. Next.
And Viagem made a markup on cost of 25% on these sales. Now Greca had $1.5 million of these goods in inventory at 30th September 20x2.
You know, by the year end, your company had how much? $1.5 million worth of goods which are in your inventory. So you are supposed to calculate the provision for unrealized profit on these goods. Then.
So number 4, Viagem's investment income is a dividend received from its investment in a 40% owned associate, which it had held for several years.
Remember the $500,000 given in the income statement. Remember 500 investment income. They say that represents some dividend received from an associate, where they are holding 40% stake and they're given $500,000, right? That is the investment income shown.
The underlying earnings for the associate for the year ended 30th September 20x2 were $2 million.
You all know this from IND AS 28. We follow something called the equity method accounting, wherein as an investor, I will not take the dividend from associate. I rather include my share of earnings from the associate. Therefore, I should take the $2 million given, which is 2,000 and thousands, okay? And on that, what is 40%? My share. It is $800,000 will be a part of my income statement and not the $500,000. Is that clear? I do not account for the dividend received from associate, rather I account for the share of income from associate. Whereas when dividends are received, the dividends are reduced from the investment in associate. And that is equity method accounting, what you guys learn in IND AS 28. Have that in mind. Next.
So next point, although Greca had been profitable since its acquisition by Viagem, the market of Greca's products had been badly hit in recent months, and Viagem has calculated that the goodwill has been impaired by $2 million as at 30th September 2018.
Now there is an impairment of a goodwill. And this impairment loss will be borne by the holding company and also the non-controlling interest, because the reason is we're going to value the non-controlling interest at fair value. Therefore, any goodwill impairment will also impact the profits available to the non-controlling interest. Is that clear? Point to note. Next.
Required. A. Calculate the consolidated goodwill at the date of acquisition of Greca.
That means I calculate the goodwill as on 1st January X2 on acquisition date.
B. Prepare the consolidated statement of profit or loss of Viagem for the year ended 30th September 20x2.
And also prepare a consolidated profit and loss statement for the year ending 30th September X2.
20 X2. Note, ignore deferred tax impact.
Again, very good. Namaste. Ignore deferred tax impact. Otherwise, you will have a deferred tax asset created for contingent liability recognized, and there will be a deferred tax liability for the fair value increase in property, plant, equipment, right? All these will be a headache. Luckily, they given what? Ignore the deferred tax impact. Good. Then
That's all.
that's it.
Yeah.
So let's go ahead and take on the first requirement. Calculation of goodwill. Yes, ma'am.
So Viagen's consolidated goodwill on acquisition of Greca as at 1st January 20X2. Investment at cost.
Now first you got to put down the consideration and the non-controlling interest. And there are two considerations. One is a payment in shares today. And also find the deferred consideration and included present value. Yes, ma'am.
Shares 10,000 into 90%.
You know, I acquired 90% of your company. So what is 10,000 shares in thousands? Okay. On that 90% is what I bought? 9,000 shares.
Into 2 by 3.
That is the exchange ratio or the swap ratio into 2 by 3.
And that into $6.5.
Then I'm going to issue how many shares? 6,000 shares at $6.50. Works out to 39,000 in thousands. Okay. Dollars in thousands. 39,000. Next.
Deferred consideration.
Very simple. I bought 9,000 shares, right, from you people.
Yes, sir.
What is 9,000 shares into $1.76? That will be discounted to present value into 1 divided by 1.1. How much you get?
14,400.
That is all. Now, if you add both, and that is a total PC. What is PC? Purchase consideration. How much?
So they've added non-controlling.
Oh, they added that also. Okay. But otherwise, it is 39,000 plus 14,400, right?
Yes, sir.
Adding both will be $53,400 in thousands. Now NCI, remember you guys are still holding 1,000 shares on that day, on 1st Jan.
Yeah, 10,000 into 10%.
Exactly. 1,000 shares into $2.5 per share. How much you get?
2,500.
That's it.
So adding all 55,900.
Now our job is to calculate the fair value of net assets at acquisition date. Now tell me, what is your share capital? $10,000.
Equity share 10,000.
And the retained earnings on 1st October, how much?
35,000.
That, and also another 3 months profits will be pre-acquisition. Yes or no?
Yes.
October, November and December. We know that from the income statement, what is the profit made by Greca?
6,200.
That is for the whole year. Into 3 by
12.
How much?
1,550.
Therefore, I can say 35,000 plus 1,000
550.
will be the total retained earnings on acquisition date. Then add a share capital.
Yes.
Then you're supposed to add a fair value uplift increase. How much?
1,800.
Very
and
good.
Also contingent liability recognized.
That will reduce the net
negative.
assets. Negative 450. Now tell me, what is 10,000 plus 35,000 plus 1,000?
550.
And then plus 1,800 minus 450.
We get 47,900 net assets on the date of acquisition.
Therefore, the difference, what is the goodwill?
8,000 is a consolidated goodwill.
Exactly. 8,000 in thousands, or you can say $8 million is the amount of goodwill as on 1st Jan X2. Of these 8,000 or $8 million, I can say that 2,000 or $2 million worth of goodwill has been impaired. Is that fine?
Yes.
The entry will be profit and loss account debit to goodwill to be written off. Now let us go ahead and take on the income statement. Okay.
Yes.
And as we go through, we should also go through some workings required. Yes.
So revenue 64,600.
That is my revenue for the whole year plus
38,000 into 9 by 12.
Your revenue I'll take only for 9 months. When I say your means Greca's, right?
Yeah.
So you were the owners once upon a time. So what happens? Take your revenue, that is for the whole year, into 9 by 12 because consolidation starts only from 1st January X2 from the acquisition date into 9 by
12.
12. From that you got to subtract
7,200 intra-group sales.
exactly intra-group, right? Remember 800,000 every year I am selling to you. So 800 into 9 months. The post acquisition. What I sold before, it doesn't matter, right?
Yes, sir.
800 into 9, 7,200 is subtract. What is the net amount?
85,900.
Then cost of,
Sales.
there is a working for that.
Working note 1.
Refer to the working. Take my cost of sales. How much?
It is 51,200.
And take your cost of sales into 9 by
12.
12. How much?
26,000 into 9 by 12, 19,500.
But from this total, you got to subtract. Remember, when I sell goods to you, for me it's a sale, for you it's a purchase, right?
Yeah.
You should remove 7,200 intra-group purchase should be removed.
Yes, sir.
Minus 7,200. And then also, you are supposed to what?
A PUP in inventory.
PUP will increase your expense, right? So find the PUP. I think $1.5 million worth of goods are there.
1,500 into
Into
25 by 125.
exactly how much?
300.
That will increase your cost of sales expense. Please add it. There's one more thing. Because of the fair value
Increase, you have to
uplift,
provide additional.
there will be extra depreciation for 9 months. What you should do, take 1,800
by 3 years.
by 3 years life, you'll get per annum into 9
9
by
by
12.
12.
How much?
450.
You got to add it to the cost of sales, increase in expense.
Yeah.
So total how much you get?
64,250.
And that is the amount to be extended to the income statement. Is that clear?
Yes, sir.
Next.
So gross profit 21,650.
Then comes,
Then distribution cost
that is nothing but adding.
1,600 and 1,800 into 9 by 12.
9 months, okay, 9 by 12. Next.
So 2,950.
Okay.
Administrative expense 3,800 plus 2,400 into 9 by 12 plus 2,000 goodwill impairment. So in all 7,600 negative.
They have included goodwill as a part of administrative
Expense.
Okay, because when you're going to classify expense based on function, you can do this way. Fine.
Yes, sir.
Even if we show goodwill impairment, separate line item, it doesn't matter, don't bother. Is that clear?
Yes, sir.
So impairment 2,000, that is $2 million impairment. Next.
Income from associate 2,000 into 40% based on underlying earnings 800.
Don't consider the dividend income, consider 2,000 into 40%, how much? 800.
800.
Then
Finance cost 420 plus 14,400 into 10% into 9 by 12 a re-deferred consideration.
no, that is
Deferred
basically deferred consideration. Refer to that point.
Yeah.
Okay. So what happens? One is finance cost appearing in my books. How much?
400.
I am a 420. Okay. So $420,000 is a finance cost agreed. But remember, the deferred consideration was, remember, present valued. So now the discount will be unwound. We say unwinding of discount. So what do you do? $14,400 on that 10% interest will be calculated for how many months? 9 months. Jan to September. So what is $14,400 into 10% into 9 by 12?
1,500.
No, the finance cost for the $14,400 into 10% is 1,440. That into 9 by 12.
Oh, they didn't calculate.
They didn't show the amount?
I will do it.
It will work out to 1,080, I suppose.
9 by 12. Yeah, 1,080.
1,080 is a discount unwound. Is that fine?
Yes, sir.
And you all know this. Whenever there is a deferred consideration, after you present value the deferred consideration, you have to unwind the discount. And the unwinding will impact profit and loss account. You know, it is whose finance cost? It is actually the holding company's finance cost. Because I am supposed to pay money to you people, right?
Yes.
It is my finance cost. Please remember that. So 420 plus 1,080, how much?
1,500.
Maybe 420 is on other loans I have. I have loans. Apart from it, 1,080. Yes.
Then profit before tax 10,400.
Very good.
Income tax expense 2,800
As it
plus
is. Yours.
1,600 into 9 by
Only 9 months, 9 by 12.
4,000.
Okay.
So profit for the year 6,400.
That is a profit for the year. How much?
6,400.
Now you are supposed to calculate the profit.
Attributable.
Let's
to
first find the non-controlling interest.
interest.
So for holding balancing figure, the parent entity, right? Just see the working for the non-controlling interest. You take 6,000.
6,000 into 9 by 12.
6,200, right?
Yeah,
Is your
6,200.
profits for the whole year.
Yes.
Into 9 by
12.
12, 9 months post.
4,650.
From this, please make some adjustments, right? Yes, ma'am.
Depreciation fair value 450 minus
450 you subtract because there is an increase in the depreciation charge. The reason is your assets have been
increase.
revalued upwards. Yes or no?
Yes, sir.
Yes, no. 450 you subtract.
Then impairment 2,000 minus.
Impairment you subtract 2,000.
Then we get Greeka's adjusted profit 2,200.
People ask me, 2,000?
2,200.
People ask me, what about the PUP? In this case, remember, PUP is created by the holding company for themselves. You know why? Because I sold the goods to you people, right?
Yeah.
Not you selling. In the previous video, remember, we would have adjusted even the PUP because you sold goods to the parent company. But here, the parent is selling goods to the subsidiary, right?
Yes, sir.
Therefore, I will create a PUP, not you. So, therefore, don't adjust a PUP. Adjust only what? The
Depreciation and
450,
impairment.
450, right?
Yes.
Depreciation and the impairment loss of how much?
2,000.
2,000. And one more thing. Suppose a non-controlling interest is not taken at fair value, then what? Don't minus even the impairment loss. It will be again borne by whom? The holding company. Is that fine?
Yes.
But here you subtract 2,000. How much you get net amount? 2,000.
200.
That into 10% belongs to the non-controlling interest. 220. Just go back. What is the profit for the whole year, for the period?
6,400.
Of that 220 goes to whom? Non-controlling interest. The balance 6,000
180 goes
will
to
be
parent.
profit attributable to the shareholders of the parent entity. Is that clear?
Yes, sir.
Got it?
Yes, sir.
So guys, please remember, if you sold the goods to me, then you will create a PUP. So while calculating the profit made by subsidiary, do subtract PUP. Got it?
Yes.
But here I am selling goods to you, therefore you don't adjust because I am supposed to create PUP, not you.
Yes.
What is PUP? Provision for unrealized profits. Got it? Okay guys,
Yes.
that's a solution. Good luck.
Yes.